All right, let's do this. Mr. Mash here. Welcome to the second part of private special situations. And in this section, we are going to focus mainly on distressed debt as well as financing alternatives for issuers in financial distress. Let's get right into this because we have quite a bit of things to cover. Distressed debt basically refers to fixed income obligations that are facing insolvency. So there's an issue of insolvency. Either they are already insolvent, or they are facing a risk of insolvency, or there's a likelihood that they won't be able to meet either their interest or principal obligations in a timely manner. That's when we say the debt is in distress. There is no universal definition for distressed debt, but however, you can observe whether or not a debt is in distress by a market price of the debt or equity obligations. Some of the indicators that you can look at to determine whether or not a debt is in distress are the bond yield spread. If the spread is over 1,000 basis points or 10% above a risk-free rate with a similar maturity, then chances are this bond is in distress. Or the loan price is below 90% of par. Also, that's an indication that the bond might be in distress. Or the equity price is near or below a minimum trading price required by listing rules. For instance, on the New York Stock Exchange, it must be a minimum of $1 per share. Anything less than that, then that might be in distress, might be a problem. So these are indications that a bond might be in distress. However, there is no universal definition to distressed debt. Some of the consequences of debt distress include balance sheet restructuring, and this is often for distressed issuers, or bankruptcy. This is an outcome of debt distress, or liquidation of assets, and this may be required to address financial issues. Okay, where you shut down shop and you liquidate. Events that are associated with financial distress include, number one, technical default. A technical default has to do with a breach of financial covenants. For instance, if you want to maintain in a covenant, you have to maintain a certain level of your debt to EBITDA, and then you exceed that value, you are in a technical default. You've violated the credit or loan agreements which are in covenants, for instance, financial covenants. Remember, financial covenants, these have to do with financial matrices or financial metrics. You have to maintain certain ratios or margins. And then non-payment is also an event associated with financial distress. This is when there's a failure to meet the payment of interest and principal in a timely manner. Typically, there's a grace period of 30 days to this. So once the grace period has passed, you have a credit event where there's a non-payment. So it's two, technical default associated with financial covenants, and non-payment where you don't pay in a timely manner. The causes of corporate financial distress, these are self-explanatory. If you look here, these are things like a poor operating performance, straightforward, uncompetitive business structure, high leverage, changes in liabilities or assets. If there are any material or adverse changes in the value of key balance sheet items, this might trigger the financial distress. Also, if there's a crisis in confidence in management. So if the management is unruly and people lose confidence in the management, maybe they've discovered fraud outright, or the management has been using aggressive accounting practices, or other financial irregularities, then there might be a crisis in confidence in management, and that might result in financial distress. So if you just go through this, pretty self-explanatory. Looking at this example, what you want to do for Modview's debt maturity schedule, you want to calculate the debt maturity schedule and evaluate possible events leading to financial distress over the 5-year restructuring period. So you can read through this. I'm going to point out the things that are important Okay, they have a 5-year restructuring plan here, and the debt profile is given here. With the senior secured debt, you see the senior secured debt here, it is 2.65 billion. So we are putting these numbers in thousands, so you can write, we remove 3 zeros here, so 2.65 billion. If you remove a few zeros, you are left with 265 million. And this is 7 years but prepayable. Since it's senior secured, you can pay at the 7th year here. And this is 2.6 billion, but it's in thousands. That's why I wrote without the remaining 3 zeros. That's the senior secured. The junior secured lien fixed rate tranche, 8% fixed, 600 million, 7 years, amortizing in 4 equal installments starting year 4. Here, you're starting year 4, 4 equal installments. You're going to divide this 600 by 4, and you get 150. So starting in year 4, you get 150,000 here. Get 150,000 here. 150,000 here. This is just the 600,000 divided by 4. And then, with regards to the mezzanine debt, it's year 10 and it's 500 million. So with the mezzanine debt, it's going to be 500 million, and then it's in year 10, which is here. Okay, we left out the other 3 zeros because our numbers are in thousands. So the total is just the summation. 150 here, 1,000, 150,000, 150,000, and then if you add 150 and 265, you must get 280. Okay, and then the last one is just 500,000 here. This is going to be the debt maturity schedule. Once you do this, you are done based on this debt profile that you're given here. Then the second part is asking you to evaluate possible events leading to financial distress, right? So you can read through and try analyze this. You see, the senior secured debt, it's voluntarily prepayable at par in year 1. This is voluntary, right? But the pay downs, we put them at year 7, but this could actually be done earlier. And these are leveraged loans. Remember, leveraged loans, they are always given with marginal reference rate plus the quoted margin. In this case, the quoted margin is 200 basis points. And if the opportunity arises, it's always better to pay first the leveraged loans because you don't know how this rate is going to move. And then you pay the fixed interest rates later on. And some of them actually, they are not amortized, they are paid at par. Like the mezzanine, they are paid with a premium at the maturity date. Okay, so there's no mandatory amortization schedule, unlike for the junior debt where you have to amortize from year 4 up until year number 7. And then over the 5-year period, some of the key causes of financial distress could be a failure to make payments on time. If payments are not made on time, that might result in financial distress. Also, there could be a challenge of not being able to meet certain covenants with regards to this EBITDA maintenance covenant. So they have to keep this covenant 6 times, and any other covenant here, there's also a 6 times covenant. So they have to be able to maintain debt to EBITDA. All these covenants, they have to be able to maintain them. Okay, and also the changes in this marginal reference rate, if it goes up, it might also make it difficult for them to pay. Changes in these principal payments or coupon payments based on the marginal reference rate might result to this credit event where there's a failure to pay the interest and principal in a timely manner. Okay, so those are some of the things that might result in a credit event. Okay, now some of the strategies that we can use to finance distressed debt can either be pre-bankruptcy, before we get into bankruptcy, or during bankruptcy. With the pre-bankruptcy strategy, there is liquidity shortfall or long-term solvency gaps. The liquidity shortfall, this is when there's a temporary lack of short-term assets. So this is a temporary, it's just a shortfall in money. And to resolve this, we can get into covenant changes. So what we do is either we change the covenant or we waiver some of the restrictions that have been put in place by the covenants. For instance, when we change the covenant, we can modify the debt agreements to avoid default. So we can either change these covenant agreements or we can waiver this covenant agreement, right? Or we can give a short-term credit extension. So what this basically means is that pre-bankruptcy, you can negotiate and such that you have an opportunity to extend your debt and pay at a later date. Okay, so that's the short-term credit extension. Debt payment rescheduling. So this is also a delay or a restructuring of payment. So you can have a delay in the payment or a restructuring here. The restructuring. So this is in terms of the liquidity shortfall. For the long-term solvency gaps, what you can do is either sell your assets or you can have a debt-to-debt exchange. What you're basically just doing here is to negotiate additional sources of financing to reduce your financial leverage. Or debt for equity switch. You can switch the debt for equity. So basically you're going to exchange the debt with another debt on different terms or more lenient terms and with a longer tenure so that you have time to pay, or you can switch the debt with equity. You can swap, you can exchange. This is for the long-term solvency. Okay, that's how these are the different ways in which you can finance a distressed debt. Either if it's long-term, you look at the assets, you look at debt for equity or debt for debt, or secured debt equity raise, which basically means you're issuing secured debt or you're raising equity capital because this is long-term. Under bankruptcy now, there's the free for bankruptcy where there's an unplanned bankruptcy filing and there's no prior restructuring plan here. There's no prior restructuring plan. So this is a free for. There's nothing you can do. It basically means you're screwed here. But the pre-packaged bankruptcy now, there's a pre-negotiated bankruptcy plan agreed upon before filing. So pre-packaged, it means there's a pre-negotiated bankruptcy plan. Okay, pre-negotiated bankruptcy plan. This is agreed upon before filing. So they agree before the filing for bankruptcy. And then this DIP, this is the debtor in possession. It means they are still in charge. Debtor in possession, they are still in charge. So there's special financing that keeps operations running during bankruptcy. So the DIP financing, you get special financing. You get special finance. And this is meant to keep operations running during the period of the bankruptcy. All right. Alternative, the other option during bankruptcy is liquidation. This is done. You sell. You are selling off company assets to repay your creditors. And this actually marks the end of your operations. Once you get to liquidation, it marks the end of your operations. So these are the different debt financing strategies that can be used either pre-bankruptcy or during bankruptcy. All right, and then during bankruptcy, we said there's a free for this unplanned. You didn't see it coming, so there's no prior restructuring. The pre-packaged one is when you actually pre-negotiate the bankruptcy plan before the filing, and then the debtor in possession, there's money given special finance so that they're still in charge, and the operations are running during bankruptcy. Asset liquidation, done. This is the end. You sell the company's assets to repay your creditors, and this marks the end of your operations. So just make sure you find a way of remembering this. This is important. They'll probably ask you this type of questions in multiple choice. Okay, let's look at this example here. Discuss the nature of Modview's financial distress as well as possible remedies to address the situation. So we want to see whether or not this is in financial distress, and we basically look at the covenants that are given. What you will see is that from the table on the schedule, there was on the senior secured leverage loan, there's a covenant of 6 times debt to EBITDA. So this has to be maintained, right? But when you come to the figures given here, you have an EBITDA in year 3 of 511 million and a debt of 3.302 million, right? So the debt to EBITDA in this year 3, the debt to EBITDA in this year 3 is going to be the debt, this 3302, EBIT, this 511. You calculate this, you get 6.46 times. This that you get, this 6.64, is exceeded the covenant 6 times. What does it mean? Do you remember? If you exceed your covenant value, what event is this? What is it called? Yes, you got that right. This is technical. Okay, so this is a technical default. This is a technical default because you have breached the covenant. It's 6.46 is greater than 6, and then you are in a technical default. Okay, what you can do, what are the possible remedies to address this situation? So there are a couple of things that you can do, right? Either you can maybe change the covenant to say, you know what, can you please just change the covenant, change or give a waiver, a one-time waiver to say we are going to let this one slide, and then you make other agreements or concessions in terms of the covenant. If you look at this with the current EBITDA level, right, you want to see by how much have they breached their covenant. It's actually a lot of money because they want to keep an EBITDA of 6, but they've exceeded and gone to 6.46. What amount have they exceeded by? If you look at the debt amount that they have, 511, right? To maintain a covenant of 6, what should their assets be? You go to, what should be their debt? What should be the debt? You take the debt, you divide by the EBITDA, which is 511, and then this should give you the 6 times which they're supposed to keep, right? If you solve for X here, it means they must have the debt of 3302. The debt, if you calculate this, 6 times 511, it's 6 times 511. If you put this in your calculator, you must get 3066. Then if you subtract 3066 minus the current one, 302, you're going to find that they've exceeded by 236 million. They've exceeded by 236 million. So, which means this company must consider also reducing their debt. Okay, they should consider reducing their debt. Or alternatively, because they've pledged all its assets as collateral except for 75 million in rail cars, trucks, and other vehicles. One other concession that they could make is to invoke an increment on their pledge on collateral. So they could increase this pledge on collateral on the rail cars and trucks and other vehicles, so that the collateral asset base is going to be increased. So they increase that. Okay, so that's high level how you are expected to answer that one. Okay, common distressed investment strategies. We have trading, non-controlling. And for trading, non-controlling, if it's trading, I mean, the name says it all. It's for trading purposes and it's non-controlling. That's the strategy. The target investment are traded debt, equity, or credit default swaps. So this has to do with not controlling, but actually trading liquid assets. The goal is to buy and hold. The approach is to seek price appreciation, capital structure arbitrage opportunity, or capital structure arbitrage opportunity. This is like how you'd trade in a public market in its short term. Remember, we said with the special situation investments in private markets, these are actually short term. So they're actually shorter term than we said with the special situations, right? SS, it's short term. In this instance, you actually see that it's less than 3 years. If you pit this against the other private market investments, these are usually 5 to 10 years. They are long term. So the short term, the trading and controlling, it's only 6 months plus or minus. In this, you buy and hold. You want the price to appreciate, and then you make money from that. Active non-controlling, again, it's active, but it's also non-controlling. You want senior secured or unsecured public or private debt, but because it's active, you actively engage in bankruptcy process, and you want to seek returns upon exit, usually for a short period, again, 1 to 2 years. And then active controlling, also straightforward. You want to get a controlling stake in the secured or unsecured public or private debt. You want to control. Active controlling goes without saying. You want to control. You want to retain ownership of the company to continue restructuring after bankruptcy exit. This can take 2 to 3 years. So active controlling is the longest one, 2 to 3 years. It still doesn't match with other private investment strategies that we spoke about. Okay, let's quickly look at this question here, which also is straightforward. It's things that you are familiar with. These are things that you're familiar with. You can read through and then we answer together. Calculate the respective yields to maturity for Falco's outstanding debts and discuss limitations associated with this return measure. The first one is a fallen angel, 1 year, 6%. So N is 1. We have 6% here, okay? And because it's 6%, it means the annual payments are going to be 6. And then what else? Both bonds recently traded at a price equals to 75% of par. So it's 75% of par, which means the present value is minus 75. You know, in your financial calculator, you put this as a negative, such that when you now calculate, and then you have your face value of the bond is 100. So when you compute the interest, it's going to be 41.33%. You do this, the next one, it's now a tenure of 3. So you just change your N to 3. Your periodic payments, 6.5. So this is equals to 6.5. What else? Both of them, they are being at a discount, 75%. So this is minus 75, and the face value of the bond is also 100 here. Again, you're going to compute the yield If you compute this in your financial calculator, you must get 18%. And then the question is asking, discuss the limitations associated with this return measure. So what could be the limitations? Remember, what we have computed here is the yield to maturity. And what is the yield to maturity by definition? You see, the yield to maturity by definition is going to be that return that you get if the bond is held up to maturity. So there are these conditions where it has to be held up to maturity, right? And then also there's no default. Up to maturity means there's no default. There's no default there. And also there is a reinvestment of coupons. Okay, there's a reinvestment of coupons. These conditions are unlikely given that we are dealing with distressed debt. Remember, we have a distressed credit fund. Because of distress, this is not a good approach to use, because you have to meet the conditions of the yield to maturities, right? All right, so this approach is not going to work because of high probability of default. All right, let's look at the second one. The credit hedge notes 40% is historical recovery rate, so it's 40% senior unsecured bonds, and estimates a 1/3 chance of Falcon default in 1 year's time. Compare the recently traded price of Falcon's 1 year bond to the estimated market price using these assumptions. Okay, so let's look at the assumptions that were given. The recovery rate is 40% and it 1/3, that's default in 1 year's time. To get the price of the bond, what we are going to do is we are going to estimate the value. Remember, the value of a bond is calculated as the face value of the bond and, if any, coupon payments divided by the discount factor and the time. Okay, and the one that we've been asked to calculate is the 1 year bond with a coupon of 6%. So this is 106. Then we divide this by the risk-free rate of 5% given here. The risk-free rate is 5%, so it's 1.05 to the power of 1. It's a 1 year bond to the power of 1. If you solve this, you must get an answer of 100.95. Okay, so that is the present value of the bond. But what you're also going to need the credit value adjustment, and your credit value adjustment is the present value of the expected loss. This is the present value of the expected loss. You see, we are told that the probability of a default is here in one. This is period 0. This is period 1. We estimate 1/3 chance of a default. So probability of a default is going to be 1/3. Then probability of no default, it's obviously 2/3, right? If there's no default, there's going to be a payment. If there's no default, there's payment in full with 0 expected loss. And if there's a default, the expected loss when there's a default, is going to be the value 106 multiplied by the recovery rate is 60%. So you multiply the expected loss is 1 minus the recovery rate, which is 0.6, and you must get an answer of 63.6 here. Okay, you must get an answer of 63.6. Hence, the expected loss now is going to be this 63.6 multiplied by 1/3. So you want to get 1/3 of this, which means the expected loss is going to be the 1/3 of the 63.6, which is equals to 20.988. Okay. The present value of the expected loss, that's the one we're interested in. This is going to be equals to 20.988 divided by the discounting factor, the risk-free rate. We get 19.99, which is like 20. Hence, the estimated market price is then going to be this value we get here, okay, minus the CVA, credit value adjustment, 19.99. If you solve this, you should get an answer of 80.96. That's how you get this. All right. But also alternatively, let's just do a quick alternative, which I think would actually be quicker to solve this for you. Let's quickly do this one. All right, just bear with me for a second. There we go. So the alternative way of doing this is to look at the probability of each separate outcome. Okay, the value that if there's no default, remember the no default value is the 100 plus the 6. There's no event, so you get the 100 plus the coupon amount, you have 106. Okay, and then if there's a default now, you get the probability of default. You are going to get 100 when there's default. The value for default, you get the 106, but you multiply this by the recovery rate. That's how much you recover if there's been a default, and you get 42.4. So to get the expected value now, the expected value is just the probability. Remember, expected value is calculating the probability times the outcome. 1/3 is the probability that there's going to be a default. Then you multiply by 42.4. Then you add 2/3. It's 1 minus 1/3. It's the probability that there's going to be no default, 106. If you add these two, you're going to get an expected loss of 85.01. So to then get the value, the present value of the expected value, you discount this using the risk-free rate. So you take the 85.01 and then you divide by the risk-free rate and you raise it to 1 year because it's a 1-year bond. If you discount it, you must get an answer of 80.96. You must get the same answer, basically. Okay. All right. So that's how you would calculate that. I hope you understand. Just try, pause, rewind, and try and get the idea of how we did it. Okay. Let's now talk about bankruptcy. We are going to quickly go through bankruptcy and then do a few more questions and then we're done. But at this point, because I'm sure you are now feeling a bit tired, or maybe, I don't know, I hope I didn't confuse you. But you can take a break, come back, and then we jump right into this bankruptcy stuff. All right. If you did go and you're back, welcome back. If not, let's continue. So the bankruptcy process, when we talk about bankruptcy, we are basically talking about these issuers that have become insolvent. Either they are insolvent or there's a very high risk that they are going to become insolvent, or they won't be able to pay interest plus the principal amount. The bankruptcy process protects the legal rights of all parties. That's the idea, and offers distressed issuers protection from creditors if continuing as a business is preferred. So this allows for orderly asset liquidation if a going concern is no longer feasible. If the business can no longer continue in business, then they have to allow for an orderly liquidation. Once a debtor files for bankruptcy in a US court, there's an automatic stay, which is a protection. So debtors are protected from creditor claims upon filing. So the US government makes it a point to protect the debtors upon the filing of bankruptcy. Fraudulent conveyance, restrictions on transferring assets to third parties to prevent creditor access, voidable up to 2 years pre-bankruptcy. So they want to avoid such that someone is filed for bankruptcy, they have assets that they want to now transfer to someone else to make sure that they don't pay what they are owing. Okay, so that's what they are referring to as fraudulent conveyance. The US laws favor debtors, those that are owing money, but other countries might have different laws that might be friendly to creditors. And the government, in some instances, is going to support companies that government support is possible for national significant companies in distress. So there are a lot of examples that you can look up. For instance, during the global financial crisis of late 2007-2008, the government actually had what they referred to as the TAP. That's the US government. The Troubled Asset Relief Program. In this instance, they put 700 billion that they used to help companies that were in distress, including Citigroup, Bank of America, AIG, General Motors, and so forth. So they got part of this 700 billion as part of release, and Chrysler as well. Then also in 2020, during the COVID-19, there was the CARES Act. There was the CARES Act in the US, and this was the COVID-19 corporate bailouts, and they gave companies like American Airlines, Delta, and so forth. And here it was actually more money, around 2.2 trillion US dollars, that was given to assist bailing out these companies, because they consider that these companies are important to the country. They employ too many people, and they contribute a lot in terms of taxes, and they contribute so much to GDP, and hence the government intervenes and assists these companies with these bailouts. Okay, so they can also be out of court quick negotiations with full creditor agreement or pre-packaged bankruptcy. Remember, you can actually feel like you're going to get into bankruptcy. Before you file, you can have a pre-package, you agree with creditors before filing for expedient reorganization. And then the free for one, we spoke about this, where you don't see it coming. There's no advance plan or credit agreement. And then the debtors control assets and must file a plan within 120 days. And typically, this is going to be more costly and time intensive because they didn't see this one coming. Okay. All right. So let's look at different bankruptcy pathways in the US. So these ones are actually quite simple, right? I don't want you to get confused with this. Even if they ask you this, you must be able to easily remember. Chapter 7, the lowest number here, that's the one that is linked to liquidation. Remember, liquidation, that's when you sell off the assets and the business is no longer a going concern. That is the end of it. And the liquidation is only under Chapter 7, and it's for corporate entities. And this is the lowest number. This is the lowest number. This is used when the debtor cannot demonstrate creditor benefits as a going concern. So the business is no longer a going concern, and then assets are transferred to a trustee to be sold, and proceeds are distributed to creditors according to claim priority, whether it's senior secured, what, and all that. You know, those different priority of claims. So the lowest number is for corporates, and it's liquidation. That's Chapter 7, and you see these are odd numbers. And I like to look at it from the smallest number here. After 7, if we go to 9, and then 11, and then the final one is 15. In terms of reorganization, you can look at what the government of a country is likely to give priority to. Okay. For instance, let's say in the US or any country, the government usually is going to take preference, and then the citizens of that country are going to come next, and then the foreigners are going to come last. And then the foreigners are going to come last. In any country, in the foreigners here. So, chapter 11, chapter 15, and chapter 9. I started with 9, where I put the government at the top. So, from 7, it's corporate liquidation, done out. And then following the number after 7, it's 9. They are odd numbers, right? 7, 9. And 9 is government. After government, citizens. The last one with the biggest number, 15, is the foreigners. So, 9, U.S. government entities, like your municipal bankruptcy. It applies to government entities seeking debt restructuring. And then you move to the next one, is the citizens of that country. 11, the U.S. citizens. So 11, it's corporate and firms seeking to continue operations as going concern. A reorganization plan to be confirmed in court under Chapter 11 bankruptcy filing. So the company becomes a debtor in possession. Remember, the debtor in possession is going to get special funding so that they can continue running the company in bankruptcy. Then they remain in control of business under court supervision. The debtor in possession, there's senior financing to maintain operations and cover costs, and they must demonstrate creditors will benefit more from reorganization than liquidation. So they must be able to demonstrate this under 11. And this is for the companies in the US. 9, it's the US government. We spoke about this one. And then the last one, 15, which is the foreigners now. This is cross-border. This is cross-border bankruptcy cases involving foreign creditors. These often parallel with home country proceedings. Okay. So 7, liquidation in the home country. And then in 9, priority is the government. 11, it's citizens. 15, it's the foreigners. But all 9, 11, and 15 are reorganization. It's only chapter 7 that deals with liquidation. Okay. So the bankruptcy process is shown here. Also quite self-explanatory, but I'll just briefly and very quickly talk about it. Firstly, a petition is filed in the bankruptcy court, right? And when the petition is filed in the bankruptcy court, 2 things happen: either automatic stay or a relief from stay. This automatic stay is when a legal hold is put. They put a legal hold that stops creditors from collecting debts. So this is a hold. It's a stop. A hold is a stop. They are stopping creditors from collecting, right? And a relief from stay, this is when creditors are going to request to lift the stay. So if the hold has been placed, creditors can now approach the court and say, we want to collect what we are owed. So the creditors request to lift the stay in specific circumstances, e.g. when they want to seize collateral. All right. And then after that, the creditor meeting proof of claims. In this instance, the creditors present claims proving that the debtors owe them money. So the creditors have to present proof that they are owed. Once the proof has been accepted by the court, 3 chapters can be gone through. The only chapter that deals with liquidation is chapter number 7. And as you remember correctly, with the order of 9, 11, 15, these are US corporate bonds. These 9 is government. 9 is government. Government takes priority, and then the US corporate, the citizens, US corporate comes second, and then lastly the foreigners. Okay, so liquidation under chapter 7. Under chapter 9 is going to be the government. Under chapter 9, like I said, is the government, and then under chapter 11, which follows after 9, it's actually the US firms, and then chapter 15 is the foreign issuers. All these 3 seek reorganization, and they must prove to the court that this reorganization is going to benefit the creditors. Then the case is going to be closed. But liquidation, the debt is discharged, assets are sold, and this is the end of the company. But the company can also continue here, also under the DIP, data in possession, where they are financed and they continue to reorganize the company to the benefit of the creditors. Okay. Let's do these questions. You can pause, attempt these questions on your own, and then when you're done, you unpause, then we continue. All right, so let's do this. If you have paused, we'll come back. Question number 1, discuss the circumstances under which excessive leverage is likely to contribute to a company's financial distress and its potential severity. So we said leverage debt, it's not really a bad thing, right? But there are instances in which the leverage can now result in financial distress. Okay? Some of the reasons are if there's poor operating performance, we spoke about this one. And also, if the debt continues to increase, if you continue to increase the leverage, you want to service debt and you service debt with debt and so forth, this might actually catalyze this financial distress. Okay. And the poor performance is also going to depend on whether or not the economy is going through. So you can also consider the business cycle, right? You can also consider the business cycle. Is the economy going through a recession or a trough, or is the economy going through an expansion? If it might be temporary movements or cyclical movements based on the nature of the business, that might also cause financial distress. So you can consider those points. And then, number 2, which of the following is the most likely strategy for a company whose debt to EBIT ratio rises above above a level defined in the maintenance covenants? Okay, so we have a technical default here. If it rises above, remember we said if it rises above, we have a technical default. And if that is the case, the only thing that you can do now, you can't continue to get more debt. You might actually want to reduce the debt. But rescheduling the debt payment could work. Okay. So if you have violated a maintenance covenant and your EBITDA, your debt to EBITDA ratio is risen below what you agreed, this reflects a technical default, and the most likely response is a short-term liquidity strategy. This rescheduling of debt, this is a short-term liquidity strategy. This is a short-term liquidity strategy. This is the rescheduling of debt. Okay, so B is the correct answer. Number 3, contrast the seniority ranking of debtors in possession financing of a company filing for a Chapter 11 bankruptcy relative to that of its existing debt claims, and explain the rationale for the relative ranking of a debtor in possession. So remember, a debtor in possession, this is a debtor in possession. You get short-term senior debt. You get short-term senior debt, and this is going to be against the debt in possession financing is short-term debt senior to all the other existing. So this has to be senior for it to be attractive. It must have a higher priority of claim. Okay. And this temporary financing is then used to cover ongoing bankruptcy costs. So the financing is used to cover ongoing bankruptcy costs, and it also provides working capital and other financing to maintain operations whilst the firm is going through its bankruptcy. which means that the lenders, they need senior status to be willing to provide this capital for them to. They want this priority for them to be able to. They know that this company is going through financial distress. It has to be disclosed. Okay, so they need this seniority in terms of claims. And you must also just remember Chapter 11. You remember Chapter 11 is for restructuring, right? Or reorganization. And we said there's 9, 11, and 15, where 9 is government, 11 is a American corporate, and then 15 is the foreigners. So we are here. This is private company, so they would need senior debt with a priority there. Okay, let's go to number 4. Evaluate the following investment opportunity available to a distressed debt investor. A FEOCO has 1 year 8% coupon bond trading at 70% of par. The investor estimates 60% chance of default for FEOCO and a 55% expected recovery. The current risk-free rate is 4%. So to be able to calculate this, right, we can do it the way we just did this, where we said there is it's 8-year coupon trading at 70% of the par. The investor estimates 60% of default. So the expected loss in this instance, the expected loss would then be this 60% chance of default multiplied by, and then a 55% expected recovery multiplied by 1 minus the expected recovery rate, which is 0.45, and then the value if there is no default. Yes, if there's a default, it's this, but the value at the end of the period is 108, 100 plus 8%, so it's going to be 108. If you calculate this, you're going to get an expected loss of 29.16. Okay, and then the fair market value of the bond, you're going to take this value, right, and you get the expected payoff, which is 108 minus 29.16, which gives you 78.84. And therefore, the value of this, the fair value, the fair market value, is then the 78.84. You divide this by the risk-free rate, you discount it 1.04, then you must get an answer of 76. Okay, so just be able to remember this. There are 2 ways that I showed you how to do this, and this approach is the one where we use the probability tree diagram, right, where we calculate the CVA. We do this, calculate the CVA, and we just consider the probability of default here, which was period 0, period 1. If we were given 55%, it means that down here it's going to be 0.45, and then we have 55 there. Okay, and then 0.55, and then also here with the 0.45, the chance of default is 60%, so you have 0.6, 60% here, and you have 0.4 here. Okay, so that's why we calculate 0.45 and 0.6, then you multiply that by what you expect to have in year 1, which is 100, the face value, plus the coupon of 8, which is 108. Okay, I hope you managed to see, but we have done something similar, so you should be able to calculate this. All right, so I hope you are following. You can also take a break again, and then when you come back, I want us to wrap this up by looking at the Merton model. This one is not going to take us a lot of time. It won't take us time. We'll just briefly talk about it, and then we are done. So if you're gone, we'll come back. So we are looking at financial distress and firm value. We are continuing with our issue on financial distress, right? And then we said financial distress is going to occur when the value of the firm decreases below the debt value. So when your value of the firm goes below the debt value, that's when you are in distress. Okay. And the equity is an option on a firm's assets. This is what we call the Merton model. Okay. The value of a firm is going to consist of the shareholders and the debt. This is something that I'm sure you are familiar with. The value of the firm is just this. The value of the firm, the assets, is the equity, the accounting equation, and the debt. You are familiar with this. The shareholders' claim is the value of the firm plus a right to put assets to debt holders upon default. So, if there's a default, the firm owners have to pay the debt holders. That's where the put option is going to come in. And this is exercised at the debt's face value. And then the debt holders, they have a claim on a risk-free debt at maturity plus the put option, which is given here, which is granted to the shareholders. Okay. So you can see the different outcomes for the shareholders and the debt holders. So these are the different payoffs for the shareholders and the debt holders. The shareholders have this they have this put option here, and they have the value of so the stock value is always like this. The payoff is increasing. When the value of the firm is below the debt, then it's insolvent. They get nothing. They only start to get a positive value payoff after they've managed to cover the debt, which is why it's going up like this. And this here is the outcome for a put option. Remember, the put option is a positive payoff. When a put option is bearish, which means there's output is positive when things don't go well, and it's going to be a 0 after that. So when the firm value is increasing, the output is going to be 0. If you add these two, this and this are going to cancel out. Then if you add this 0 plus this upward, it continues to go up, which means they have an unlimited upside. They have an unlimited upside. The shareholders have an unlimited upside, continues to go up. And then when you look at the debt holders, the payoff for the debt holders, they have this put option that they have sold here. They have this put option, right? And also they have a risk-free return on the debt. So they want this amount, this fixed amount. Whatever happens, they want to get this return. However, the total value that they get should the firm not do well is going to be dependent on how much value of the firm has been lost. They will get part of the value, but not all of it, until the firm is recovered. They've recovered their debt, and then they get a fixed payoff from here on going forward, where the firm is solvent. So they have a limited upside potential. They have a limited upside potential, but the equity holders do not have that limited upside potential. It's unlimited. All right. This can actually be explained by using the put-call parity. Remember, with the put-call parity, you are going to have, if you look at this side, you have the value of equity and the value of this put option. You can show it like this to see the outcome here. To say you have your exercise value here. Let's say this is your exercise value X. And the value of equity is going to be increasing in this way. This is the value of equity increasing. If you add the put option is going to, remember the put option, the payoff is high below the strike price. That's the nature of the put option. And then it becomes 0 after that. If you add these two, you're going to realize that before X, if you add this and that, you're going to have a high output, because here you have a positive output, here you have a positive output. If you add the two, you're going to have this high output here, which goes on until you get to X here. And once you get to X, you have this output. This is 0 now. This goes down to 0, but this continues to increase with unlimited upside potential. So this is going to look something like this. If you add the put option and the value of the equity, the stock price, which is always going to be a straight line like this, that's the payoff. You can do the same for the for this call option, because for the call option, the payoff for a call option is simply 0 on the downside and up on the upside. This is the output for a call option. And then for the risk-free, the output is the same. It's like this. This is for the present value of a risk-free. If you add these two again, it's going to give you a similar output, where here it's 0 plus this, which is this amount, right? Until it gets to the strike price X here. Then it's going to take this plus this. So it's going to start from here and it's going to go up. So these two are the same, which is the put call parity, where the value of the stock plus the put is equals to the call plus the risk-free bond, which therefore means that the value of the firm is the value of the call plus the value of the risk-free bond minus the value of the put option. Okay, so this is an important relationship that you have to also remember. You must remember this in terms of the put call parity. Okay, the interpretation of the sold put, it represents the credit spread. So the sold put, this, it represents the credit spread or premium over the risk-free rate that is used to cover the default risk for the debt holders. They are going to be compensated because they have paid this premium, and they are compensated if things don't go well and the firm value dips and goes below the debt value. The significance of structure models is that structure models, they link credit spreads to equity prices. In these models, they assess the market value of assets versus fixed obligations, and then they provide insight into default probabilities and complex investments. So these are the significance of these structural models. All right. And then if you look at this structural model of default, what you see is that the firm value is seen to be going up to a period of point time t, and then the value, the distribution is a normal. This is a normal distribution, right? With a volatility of, remember, the normal distribution is defined using the mean of the distribution is defined with the mean and the variance. So the volatility is given by sigma here, and the value of the firm is going to be divided between equity and debt, right? The value of the firm, like I said, is going to be divided between the equity and the debt. Remember, we said this goes back to the accounting equation where the assets are going to be equity and liabilities, right? So the equity and debt. The value of the equity of the firm, it has unlimited upside potential. So it's going to be the maximum of, if the value continues to go up minus the debt, that's the value. But once this number becomes negative, the equity holders get nothing, 0. It's going to be 0 here. And then the debt holders, their value is going to be the value of the firm minus the maximum of the value minus the debt. Okay, so should this become equal, it means the debt holders, the equity holders get nothing and they get everything. So they are going to get the residual value should things not go well, and if should this be negative, the debt holders are the ones that get the residual value. Okay, which therefore means that these debt holders, they hold a covered call. They're going to hold a covered call. They hold a covered call position on the firm's assets. Covered call on firm's assets. Okay. And then with the structural and Merton models, these are going to be based on the Black-Scholes Merton BSM option pricing models. And with these option pricing models, you will remember this, that the equity is modeled as a call option with the value V minus D, where S is the stock price and X is the exercise price, which are going to be replaced by V. So the stock price is replaced by V, and the excess price is replaced by D. And then we model in a very similar way in which we did the Black-Scholes Merton model. And these equations are equations that you are familiar with, right? You remember that the equity value, where we had the equity value was this value of the firm multiplied by this, which we said is a normal distribution. It follows a normal distribution. You find these values from the normal tables. Then you subtract the exponential value times R, the risk-free rate, times the time period, times D, the debt, times the normal distribution. So this relationship is something that you're familiar with, where your D1 and D2 are given by these equations. I don't think the exam is going to ask you to calculate this, but we'll see. And then a DT is the debt value prior to maturity. The credit spread is going to be just given by the 1 over T multiplied by the ln of D over dt minus R. You're going to understand this with an example, right? We're going to do an example for you to be able to understand this, but just a refresher, just take a look at these equations. You have done this before when you looked at the Black-Scholes model in level 2. So these are equations that you are familiar with, and hopefully you can be able to refresh your memory on those equations, right? What I want to do, right, is to just quickly do an example with this. I want us to do an example with this, but I'm going to take a break, conclude this. I want you to take a look at this question, try apply the formulas in the previous page to solve this, and the next one. When we start the next session, before we start, I'm going to go through these two questions and apply the Merton structural models to solve this, and then just explain a bit how you go about doing that. But for now, I think this session has been a bit too long, so we are going to continue, and yeah, this video has been a bit too long. I can actually feel it. We are going to continue in the next session, but for now, I want you guys to keep on pushing and practicing. Enjoy capital markets. Mr. Mesh is out. I will see you in the next one. Cheers.